You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The Small Business Administration issues loans that are pooled into securities backed by the full faith and credit of the U.S. government, have a quarterly adjusting feature, and have no floating rate cap. SBAs, as these securities are often called, have appealed to many investors during the last 2 years of elevated interest rate uncertainty and other macroeconomic fluctuations. On today's episode, we talk with Matt Peterman and Ruben Rodriguez, Senior Vice Presidents of SBA Trading with FHN Financial, about the structure of SBAs, how the SBA market performed through the pandemic economy, and the security's strategic role in the current interest rate environment. Stay tuned. Coming up soon, our interview with Matt Peterman and Ruben Rodriguez, Senior Vice Presidents of SBA Trading with FHN Financial. But first, a quick market update. The April CPI came in mostly as expected this week, quelling fears that high first quarter inflation was a sign of a new accelerating trend. The 0.3% increase in the core CPI is not entirely consistent with the Fed's longer-term target, but it's a welcome improvement from 3 consecutive months of 0.4% core CPI increases. The headline index increased 0.3% versus the 0.4% consensus expectation as well. The details broadly suggested moderation in some of the more concerning components from recent months, though the underlying trend is still too hot for the Fed to consider cutting rates anytime soon. The Treasury curve bull flattened after the release by 5 to 7 basis points, bringing yields on all tenors to their lowest since early April. Yields on 2-year Treasuries are comfortably below the 5% support levels we saw throughout most of last month at 4.75%. At 4.33%, yields on 10-year Treasuries are 40 basis points lower than their year-to-date high of 4.73% as recently as the last week of April. Fed funds futures are now suggesting expectations for the first Fed rate cut at the September meeting, with another one by the end of this year. The post-CPI rally solidifies the bond gains from the weaker-than-expected April employment report a couple weeks ago, and for now allows investors to look past the hotter-than-expected April PPI that also came with downward revisions to March data. Also this week, flat retail spending fell short of the 0.4% expected increase after sizable March increases. The weak consumer spending report pairs with a nearly 10-point collapse in consumer sentiment last week to suggest an economy at a slightly lower risk of overheating. A handful of Fed speakers the last 2 weeks stuck closely to the current narrative of being patient with potential rate cuts, while still suggesting a very low probability of potential future rate hikes. Now that the April CPI has been released, we'll be keeping an eye on how FOMC participants could have rising confidence that the worst inflation is in the past. The first 3 post-refunding coupon auctions from the Treasury were all digested well last week. The auctions for 3-year, 10-year, and 30-year securities saw solid demand and no upward pressure on yields that would suggest difficulty absorbing the elevated issuance. That's all for the market update this time. Now our interview with Matt Peterman and Ruben Rodriguez. We have 2 guests joining us on the podcast today. Matt Peterman, Senior Vice President and Head of the SBA Trading Desk at FHN Financial, and Ruben Rodriguez, Senior Vice President of SBA Trading at FHN Financial. Matt and Ruben, thanks for coming on the podcast.
Hi, Will. Thanks for having us.
Hey, Will. Thanks. We appreciate you having us on.
Our topic today is the SBA market, how these securities differ structurally from other fixed income securities and how they fit into the overall financial system. So those letters, SBA, stand for the Small Business Administration. Ruben and Matt, before we get into the finer details, can you give us a quick overview? What sorts of businesses are getting these SBA loans? How do they get pooled in securities, and how long has this market been around?
Will, you alluded to the SBA, Small Business Administration. It's an agency of the U.S. government. The 7A program, which we'll be discussing today, that's been around since the 50s. The pooling program started in the 80s. A lot of your audience may be familiar with SBA, in particular during the COVID era when the SBA implemented the PPP emergency program. That was brought to the forefront of everyone, not just the investment community. But again, in today's podcast, we'll be focused on the 7A program. Now, the types of borrowers your typical small businesses, such as daycares, mechanic shops, coffee shops, a lot of the stores that you see in your local shopping centers, but also you can see bigger businesses as well. The max loans for SBA 7A loans are $5 million. So you can see some big businesses as well. But it's your typical small businesses that you see on your drives to work or when you're going for a run, that you're running by or walking by.
So that's really helpful to know that among the different kinds of SBA securities, we'll be talking about 7A, and I think that is the most common, the most popular. Is that correct?
Correct. That is the flagship program for the SBA.
Got it. Okay. So an important question that I think comes to mind is, of course, the level of credit risk for these securities. Does the connection with the Small Business Administration mean they are backed by the government? And how does this tend to affect how it's priced?
Let's use the example, the large loan, the $5 million loan. Say the lender originates a $5 million SBA loan. Well, the SBA will guarantee 75% of that loan. So that'll be $3,750,000 is guaranteed by the U.S. government. Now, when that loan is sold into the secondary market, it carries an unconditional full faith and credit guarantee of the U.S. government for principal and interest. So that 75% of the $5 million loan is purchased by pool assemblers such as FHN, and we pool similar loans together and create SBA securities.
So if we take the Treasury market, for example, the federal budget impacts the level of issuance and thus the pricing for Treasuries. I have to imagine the SBA market can really fluctuate if there are unexpected legislative changes that change the number of small business loans issued. So is the SBA market considered big and liquid enough to smooth out any of those fluctuations?
Yes, for sure. It's considered liquid, I think, by all measures of liquidity. Taking those kind of one at a time in terms of legislative risk that can cause swings. Not really. We can't say it's non-zero, but we certainly view it as very limited. The reason being, small biz in general is considered to be by nearly all political pundits sort of an untouchable. Neither side wants to be viewed as doing any damage to, the backbone of America, or the American dream, if you will. It's also worth mentioning that the 7A program itself operates as zero subsidy. So anytime that the agency comes up in any of those congressional discussions about the budget, that surely is a positive for the program.
And how big exactly is this market of SBA securities?
Yep, that's a good one. Overall, the tradable balance for SBA pools outstanding, the number's just shy of $38 billion as of the most recent March factors. So clearly, we're more of a niche market than as compared to the trillions in the Resi MBS space, for example. But it's important to note the total size of SBA 7A is constrained to the extent that SBA is an agency of the government and therefore subject to authorization caps. So both the 7A loan program at that level, it's capped at $35 billion annually. That's flat for 24 versus 23, and at the secondary market guarantee program level, where it's capped at $15 billion. So, in other words, if every single 7A loan that's sold into the secondary was pooled, that would lead to $15 billion in max pool production for a year. But of course, not every 7A loan that's sold in the secondary is pooled. There is a natural market for one-off loans, whether it be institutions looking to expand their own portfolio or perhaps book 7A loans for CRA credit or something like that with their regulator. The result is that in actuality, collective new annual pool production runs between 7 to 8 billion going back about the last 7 years, with a couple of blips into the 10 billion during the COVID era.
Now, because these loans are made to small businesses, I honestly have no idea the kind of length of time that most of the loans are going for. But is there any rule of thumb or general heuristic about how SBA 7A securities are being priced? Is it, based off of the 10-year Treasury? Is it off of Fed funds? How does that market kind of, the foundation of it, price itself?
The underlying loans that are in these SBA pools, they trade at premiums, and they trade at pretty healthy premiums. That has to do with the loan is indexed to the prime rate, and usually it's indexed over. So what we call a full coupon real estate loan, it would be indexed to prime plus 2 3/4. and that's the gross rate to the borrower. So at 8.5 prime, you can see very high coupon. So the lender is expecting premium based on current market. So some pretty hefty premiums. Now, there is different fees that are cut out before the investor gets the net coupon. There's a 1% servicing fee that the lender has to keep, an FTA fee, also an SBA fee. So the amount that can be passed through to the investor is pretty much close to prime plus one. So when we're assembling a pool, say they're all brand new loans, a pool priced at a full coupon would probably be in the low 111s, high 111, somewhere in that range. Now, say we wanted to create a pool with the same loans, but have a lower dollar price, and what we would have to do is strip that coupon lower, and in turn taking out premium. So you can create lower price point pools, but the price of the pool, if considering all things equal, that they are made up of brand new loans, it doesn't mean that one pool is better than the other or one pool is going to pay faster than the other. It has to do more with, I guess, the risk and being compensated for taking more premium risk. I think one thing we didn't mention is, although the principal and interest is backed by the full faith and credit of the U.S. government, the premium is not. So if pool pays faster or prepays faster than you anticipated, then you will have to write down those premium dollars associated with that prepayment.
You mentioned that SBAs are pretty liquid and are considered to really not have any credit risk. So what is the appeal of SBAs? What makes them stand out compared to a lot of the other fixed income securities out there that are also liquid and have no credit risk?
Again, these are true floaters. They're uncapped. They're quarterly adjusting and backed by the full faith and credit of the U.S. government. So although there are alternatives to SBA floaters as an asset class, there's very little securities out there that have all three features. Again, backed by the full faith and credit of the U.S. government, quarterly adjusting feature, and no cap. So in this environment, I know a lot of investors that we spoke to, they had or have mandates that they have to have floating rate securities in their portfolio. So this is just another asset class that's sometimes overlooked, that now investors are trying to look for more diversification in the floating rate sector and are looking at SBA pools now. In addition to that, we also beginning requests using SBA pools for CRA. We usually get that request later on in the year, but it looks like more attention from regulators and investors are wanting to address CRA at the beginning of the year or early on. So we have begun inquiries for that. So some investors are not just looking at the floating rate feature, but using it for CRA. We can actually have a podcast strictly on CRA, to explain the process, but that is something the SBA floaters are being used for now, again, because these loans are being made to, your typical small businesses.
I don't want to make any promises to our listeners, but we do have plans for a CRA episode in the pipeline. So it's funny you should bring that up. We just talked to a potential guest this morning. But in any case, that quarterly rate reset, I can see how it is appealing in the inverted curve environment right now that we have. So you could take advantage of higher short-term yields, and then once the curve normalizes, it steepens, maybe shift into longer duration assets. But once the curve normalizes, does that appeal of SBAs go away?
Yeah, right. I mean, I see where you're going with that, Will. Not necessarily. With floaters, there's a few moving parts to the story, of course, pun intended. Keep in mind, the main attraction to this sector, the 7A floater sector, is for depositories, and it's to, increase the alignment of their assets to their liabilities. So in the form of liabilities that are funding costs like demand deposits and things that reset off the front end of the curve. So if the curve starts to normalize as a result of the Fed bringing down Fed funds and the front end follows, it also brings down these funding costs as banks can source funds more cheaply. So the result, in theory, is that the spread they're achieving in their 7A investments still remains intact because they're earning that, that ARB, if you will, versus what their assets are earning and their funding costs. The other part of the equation that's helpful if the curve normalizes to more of a positive slope is that the refi incentive is further removed than in the current environment. And that's because the fixed rate alternatives that price off the long end of the curve should carry higher rates than the floating rate 7As that are pricing off the front of the curve, as the Fed fund rate and the prime rate move in lockstep. So in theory, less refi incentive should or could lead to a slowing of prepayments, which of course then boosts the yields on the 7A investments.
All of the interesting aspects of the structure of SBAs, I wonder, are there particular institutions that tend to be in the SBA market? And could this change based on where we are in the economic cycle? Or are there some that you would always call the quote unquote typical buyers?
Yeah, great question, Will. Yeah, so our typical buyers pretty much through all cycles are depository institutions, your banks and credit unions, using for a wide variety of reasons. Given again the quarterly adjustment feature, asset liability management. These are tied to the prime rate. Prime rate is perfectly correlated with Fed funds. So as the Fed is moving rates up or down, the prime rate adjusts and locks. Thus, these coupons are adjusting again with the Fed. So they are quarterly adjusting, and there will be a lag up and down. But pretty much, when the Fed adjusts the rate, eventually the coupon will follow. I guess that's another thing to mention is in this space, when the Fed was raising rates up, the coupons were lagging on the way up. But now when the Fed begins to decrease rates, say, for example, if they I think the market is expecting 2 cuts maybe this year. They were expecting 3. But say if we get a cut in September, the quarterly feature of these pools, they'll adjust down in October. Say again, they decrease rates in November. The next time these securities will adjust down are January 1st. So there was a lag when we were going up, but there will also be a lag going on the way down if you are using these and setting them off of some short-term indexes. There will be a lag. Another thing, as I mentioned earlier, is banks are using it for CRA credit. So that's another reason depository institutions are using this asset class. And then another reason is just Fed funds has been so high for over a year now. Some investors are coming in just for an outright yield play, depending on what type of prepayment scenario you use. These can yield 6%, a little higher than 6%. And if you're looking at lower premium, you can high 5%. So it's an attractive asset class, even when comparing to some fixed rate alternatives at this point.
Looking back at the last 4 years, we've seen huge changes with economic activity, fiscal policy, monetary policy, financial market volatility. And even though the Fed's aggressive tightening in the last couple of years, things have been changing in that way at such a quick pace. But it's relatively smooth compared to, let's say, April of 2020, when it looked like the sky was about to fall. During the last 4 years, did the SBA market manage to function smoothly through this period, through all of the roller coasters that we've been through? Or were there times that were particularly challenging?
Yeah, that's a great question. I can see you're good at this, Will. Smoothly might be a stretch. Maybe let's go with smoothly adjacent. There were, as you mentioned, 2 major disruptions in the last 4 years, and I think each of them kind of deserves their own airtime, if you will. First, of course, was the COVID pandemic starting back in the early 2020, really covering the next couple of years after that. COVID gave us a great glimpse at just how the government views all things SBA as systemically critical. At the start, the SBA market, despite the full government guaranteed status, it was not immune to some of the price disruptions seen in nearly all asset classes. However, the disruption was very short-lived, and by early March of 2020, Congress was already passing the $2 trillion CARES Act, and that included all kinds of relief for all things SBA, basically for this market at all levels. Within CARES, there was direct payment coverage for 7A loan holders, so that filtered into 7A pool payments. In addition, the aforementioned PPP funding. Most of you probably remember stimulus checks, which further supported the sector. Finally, there was the greater financial crisis era TALF. That stands for Targeted Asset-Backed Loan Facility. This was a facility that was reopened in a Form 2.0 during COVID to help restart the asset-backed securitization markets in particular. SBA 7A was on the short list of eligible collateral for that program, and that led to a wave of buying support that quickly buoyed pricing to well above pre-COVID levels. The second major disruption was last year's regional banking crisis. That affected our markets in two ways. Firstly, of course, depositories as the main sponsor. The liquidity crunch that many of them found themselves in led to a swoon in the pricing as a combination of selling by existing holders and a lack of new buying gave way to depressed pricing levels. But secondly, and most importantly, was the fact that Signature Bank was a leader in the 7A assembly world at the time. And many of you probably remember that they were one of the first banks that were taken into receivership by the FDIC around March of 2023. So the upshot of that is that nearly $1 billion of existing 7A pool securities was auctioned midsummer into a market that was, for all intents and purposes, devoid of any of the normal buyers. In hindsight, that was a tremendous buying opportunity, and a few of the more opportunistic, long-standing pool buyers did manage to raise funds and get in there and take advantage of it and add. But it also helped that the general health of depository balance sheets kind of improved towards the end of last year and allowed them to come back in and start sponsoring the market again and supporting pricing. In both cases, though, it's important to note that any pricing disruption was really short-lived. It was a temporary situation, and the market fully recovered within a very short period of time.
That's interesting that the regional banking crisis of March of 2023, as you describe it, it was a bit of a fire sale of supply, and then buyers who might step in to kind of buy the dip were themselves very short on cash or very risk averse, which of course can have a downward spiral. But the market did prove some sort of stability, and I guess to paraphrase Jerome Powell, it was not a smooth adjustment, but a smooth-ish, in the way that he described a soft-ish landing when the thought was that the unemployment rate had to go up. I want to end by looking at the environment for where we are while recording this in the middle of April. There's an expectation for the Fed to cut rates later this year. As Ruben alluded to, market expectations are closer to 2 rate cuts instead of 3 as recently as the beginning of this week. But the big question, especially after the recent inflation data, is on the timing and pace of cuts. So how do SBA securities fit into this environment where rates will most likely come down, but we're not really sure when?
I think, Will, the beauty of this 7A floater space is that the uncertainty works just fine. Buyers don't have to be right about the pace or timing of cuts. So if we're higher for longer, that's a good outcome, of course. They enjoy the carry that they're enjoying right now, much of which is higher than any fixed rate alternatives. And if we flip a switch and they do start to cut maybe even sooner than people are expecting now, that should be okay too for some of the reasons we've laid out earlier. The funding arb, we assume that their funding cost is going to be dropping in lockstep with Fed funds, and so they're still going to have that spread be intact. And we also expect in that sort of environment that prepayment should slow, which will sort of counterbalance some of the yield that goes away by virtue of the coupon levels going down.
Matt and Ruben, thank you for coming on the podcast.
Thanks, Will.
Thank you very much, Will. We really enjoyed it.
That was Matt Peterman and Ruben Rodriguez, Senior Vice Presidents of SBA Trading at FHN Financial. As we look to the likelihood of rate cuts later this year, Matt and Ruben make an interesting point about how the quarterly adjustment of SBAs means that coupons will stay high for a bit longer after the Fed eventually lowers the Fed funds rate. Also, the resilience of the SBA market stands out to me considering its smaller size relative to the Treasury and MBS markets, and how much financial market turmoil there has been throughout the pandemic. Next week, preliminary data on durable goods orders for April will help contribute to Q2 business investment estimates, while revisions to the University of Michigan Consumer Sentiment Survey for May could show changes to the preliminary release that reported plummeting sentiment and rising inflation expectations. The more important data releases will be the following week, starting with the first revision to Q1 GDP on Thursday. The next day, the April PCE report will end the month, giving investors a better sense of how the April CPI channeled into the Fed's preferred inflation measure, and whether April retail spending weakness carried through to the more comprehensive spending data. Public appearances from Fed officials fill the calendar over the next 2 weeks, with nothing from Chair Powell currently scheduled. The minutes from the FOMC's May 1st meeting will be released next week and could shed light on how participants felt policymakers should react to the higher inflation data at the time. The Fed's Beige Book will be released the following week. The big post-refunding auctions also continue in almost 2 weeks, starting with the auctions for 2-year and 5-year notes on May 28th. followed by the 7-year note auction on May 29th. Keep in mind the last week of the month will have only 4 trading sessions, with the Memorial Day holiday falling on May 27th. That's all for today's episode. Thanks again for listening. I'm Will Comprell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.